Welcome to this second video dedicated to trading gold and silver. This time we will talk about risk management and margin requirements. On this slide you see brief contents of today's video. First of all, we'll talk about calculating lot size, cost of a pip and margin requirement, how to calculate it, how to take it into consideration. Then we'll talk about stop placement, how to calculate lot size for placing a correct stop. Then we'll talk about slippage, and finally we'll talk about practical tips for risk management, about fundamental drivers and triggers which influence gold and silver markets, about short coverage and long liquidation rallies which occur on these markets from time to time, and execution during such times may be pretty much different from execution during normal time or normal market condition. Before we start, let's take a quick look at the disclaimer. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. Risk of trading in financial markets can be substantial, and you accept full responsibility for any of your trading decisions. Past performance is not a guarantee of future returns. Let's talk about practical aspects of risk management, and we will start with margin requirement. There are several concepts and terms which you need to know. First of all, volume. How volume is calculated on gold and silver. Number of lots is calculated by contract size. So, for example, if we take one lot, one single lot, we'll multiply it by 100 and we get 100 XAU. This is our volume. To calculate margin, we have to use the following formula. We multiply lots by contract size and divide it by leverage multiplied by 2. Well, in our case, we assume that we have leverage 200 to 1. It may be 100 to 1. If you have leverage 100 to 1, you use 100 here. If you have 50 to 1, you also use 50 here. Now, how to get margin requirement for one lot here? In these circumstances, when you have 200 to 1 leverage, well, you should get the current quote of gold. Now it is equal to 1263 or so. So you should multiply it by 1 and you get $1,263 as a margin requirement. That's pretty simple, as you see. The next important piece of information is cost of a pip. You need to learn to calculate cost of a pip if you want to calculate a stop loss size correctly and size of your position correctly as well. To do this, you calculate point size by the contract size and multiply it by number of lots you are trading. And for this particular case, your cost of a pip would be equal to $1 American. If you are a position trader, if you want to hold your position for weeks or even months, you should take care of swap point. Use this formula to calculate swap point. In this particular case, the swap point for long position would be minus 4.5, and for short position it would be minus 1.02. Now let's talk about most practical aspect for short-term trader as well as any other type of trader. Stop placement and lot size calculation. To calculate a lot size correctly, first you will need to calculate the cost of a pip which you should have for your position. In this particular example, if you need to place your stop at a point 1282.99, starting from the point 1280, it means that you have 2 full points of price covered by the market when you want to exit your position. In this case, we have 2 lots. We should accept the position of 2 lots because 1 full point would be equal to $200. Let's assume that your maximum loss size is equal to $400. Imagine that you have a pretty large trading account and you have $400 as your loss size. Maybe it might be 4% or 2% of your account. So the full point would be equal to $200 because you have two contracts here. If you would have one contract here, one full point would be equal to $100. By the way, if you don't want to calculate everything discussed above manually, you can still use Traders Calculator, which is available on official website of Exness Company by the link that you see here, www.exness.com/tool/calculator. You choose XAUUSD here, and you choose your leverage, and you choose your lot size, and you get the cost of a pip. Imagine that you have 200 pips between your entry point and stop loss point. So you can adjust your lot size manually here to calculate your lot size so that your cost of a pip would fit your risk parameters. I also want to remind you once again that one full point is equal to 100 pips. When you trade gold or silver, you also have half of a pip. For example, you have a quote 1280.721. The pip actually is represented in these two digits, 7 and 2, 72 pips. If you have one single contract, it means that if price changes for 0.72, you would have profit or loss equal to $72. How to place your stops correctly? Well, to do this correctly, the first thing that you should remember about is daily average true range, daily ATR. You can apply this indicator to a daily chart and see the average daily volatility. In this case, it is equal to 10.3. Well, let's go through a practical example. I'm having a short trade right now, and I want to place a target for this trade. So I'm having highest point of the day equal to 1266.37. If I subtract 10 pips from here, I get my take profit equal to 1256 or so. So it is located somewhere here, as you see. So it's not a big deal. Maybe if you're a trend following trade, it would be not very big profit for you, but if you're a day trade, it's basically okay. It gives you 3-to-1 profit loss ratio. For stop placement within a day, I would recommend to use not daily ATR but ATR on your time frame where you are working on. For example, for 30-minute chart, which is my working time frame, I have ATR equal to 1.23. So to have my stop secured, I should multiply it by 2, and my stop loss would be equal to something like 2.5. That would be my stop loss. If I place it by volatility, not beyond any levels, if I just enter a position and don't have any technical levels to place my stop beyond. If I just enter at some average point, I can use ATR from my time frame to place a stop and ATR from a daily time frame to place a target. It is worth mentioning that gold and silver markets are relatively less liquid than currencies, for example. So it means that from time to time we can see very rapid, very directional, very volatile swings on gold, which can lead to incorrect execution. So in other words, if you place a stop loss order, you should take slippage into consideration. And when you execute your order, you can enable maximum deviation from quoted price. Well, I would mostly recommend you to avoid dangerous times to trade gold, or to avoid holding your positions before some important political events, or holding your positions when you have a strong trend going forward. Take a look at this chart. What do you see here? Well, most of the time gold is trading smoothly, since it is traded 24 hours a day. Mostly, sometimes we have volatile swings due to some fundamental context, some news, some events. For example, we may see gaps between Fridays and weekends, Fridays and Mondays after weekends. This particular day of April 17 was a Monday followed by a weekend which was politically very anxious. This time North Korean administration was going to make a strike on American battleship, and they said that they would counter reckless acts of aggression with whatever methods the US wants to take. So in case it happens, in case something unexpected happens, some war or some airstrike with something similar of the kind, gold would immediately react by the very rapid bullish breakout to the upside. Of course, you don't want to position yourself on the wrong side of the market during that time, because your stop loss may not be executed as you expect. Well, first thing which I recommend to do is to consider underlying trend, where underlying trend is headed, because if you see bullish trend, then possibly you would see rapid breakouts to the upside. For bearish trend, of course, upside breakouts would be limited, but you also take it into consideration. If you have some political meeting, some statement on something of the kind ahead, you should be aware, because gold may react. Also, you should monitor major economic releases just for any currency pair, like interest rate decisions, like employment data, and other important releases. So there are three major drivers which affect prices of gold and silver. Economic releases, just like for currencies, anxiety, tension, political context, something which is happening outside of the markets, in society, in politics, speeches of administrations, of presidents, and so on and so forth, and other drivers. Other drivers are mostly fundamental when market is afraid of some stock market crash, or it is afraid of something unexpected which may happen in the market. For example, if there is some bubble on the stock market or in the bond market, the gold may rise. So it is not happening overnight. It may result in some trend which you would see within a period of several months. Okay, thank you for your attention. This video was prepared by Stanislav Bernehoff and Exness Company for you. See you in the next video. Good luck.